Welcome to Dorsey and Whitney's webinar on preparing for the 2021 SEC reporting season. I'd like to introduce Hoang, a partner in Dorsey's Corporate Governance and Compliance Group. Take it away, Cam.
Thanks, Sean. Good morning, everyone, and welcome to our annual panel. I'm joined by my colleagues, Kimberley Anderson, partner in our Seattle office, and Anthony Epps, a partner in our Denver office. You can find our bios and contact information at the end of this presentation. Just a few housekeeping matters. Today's program is 60 minutes and we'll be sending out supplemental materials and an attendance form. You should look for it through an email, events@dorsey.com, and please return the completed form to attendance@dorsey.com. I'm afraid we're not going to have any time for questions today, but you are welcome to contact the presenters or call on your trusted Dorsey contact. In today's presentation, we will be covering need-to-know items for the 2021 SEC reporting season, including 10K and proxy developments. And honestly, who could have anticipated the seismic changes in 2020 that have transformed our society and that will have profound effects on the upcoming reporting season? We'll start with Anthony and COVID-19 disclosure trends for the 10K.
Fantastic. Thank you, Cam. I think, none of us could have anticipated what 2020 would bring. I always joke with colleagues that back in January and February, I had plans and did different things, but COVID hit us all, and we're really trying to adjust. We've gotten used to Zoom meetings and Zoom conferences to Zoom webinars, and COVID-19 has really had a profound impact on our society. And because of its profound impact on our society, we really need to address COVID-19 in the upcoming 10K and proxy season, just to make sure that we're adequately disclosing what the COVID-19 risks are. So the Washington Journal, they did a survey, I want to say back in October, and they talked to a lot of different compliance officers in-house and in various companies, and just to discuss with them what types of risks, what were they seeing now that COVID-19 has impacted their businesses. And most of them, as you can see, chose cybersecurity. Cybersecurity is definitely a big disclosure issue or a big issue, because now that a lot of people are working from home, you have to make sure that your network systems are secure and safe. You have to make sure that you're protecting client and customer data in a remote work environment. So very, very challenging, and a lot of risks associated with that. Same thing with privacy issues. It's a lot easier to protect privacy when you're in a physical location together rather than multiple locations across the country and across the world. Definitely business digitization. It's been very interesting and exciting to see how businesses have really taken up the challenge of how can we address COVID? How can our business continue to work in a remote environment? Supply chain disruption, when you've got shelter in place orders and work from home orders, and people aren't as free to be able to go where they want. You of course have supply chain disruption, conduct, financial crime. All those things are definitely big areas of disclosure. So what we're going to get into the next slide, which we're going to talk about MD&A considerations. So coming up this year, when you're thinking about your MD&A, I'd like to think that you'd focus on two areas. You've got your operational considerations, and then you've got your liquidity and capital resources considerations. So what does that mean? So for operational considerations, it's really important to describe the extent to which a company has altered its operations. So you can have shelter in place, remote work, data security. If those items are important to your organization, it's really important in the MD&A to really flesh those out and really talk about how these different considerations are affecting your operations. But for example, if you're a manufacturer of some sort of device, and you you manufacture those devices in a state like California or in a state like Washington, or earlier in the summer, a state like Colorado, if what you were manufacturing, if you're not considered an essential worker, you were probably having to shut down or having to figure things out on your end. And so to the extent that that's had a material impact on your revenue, on your projections of what the company is going to do for that year, you definitely need to disclose that. Same with remote work. So some companies have been negatively impacted by remote work, and other companies have been positively impacted by remote work. So to the extent that there's been changes on that front, and then data security, we already talked about that. To the extent that there's been a data breach or you're having data security issues, you probably won't want to disclose that. What's interesting about the operational considerations is it's not just a backward-looking analysis, it's also a forward-looking analysis. One thing the COVID-19 pandemic has forced a lot of companies and a lot of industries to do is they evaluate how they're operating and how they're going about doing their business. For example, that there are some companies where they've had such a roaring success of people working from home, productivity has been up, that they've just decided that, hey, we don't need to have a physical corporate headquarters anymore, or we can downsize our physical footprint with our buildings and our leases. That those are definitely things that companies and organizations, to the extent that those are in the works, or to the extent that companies are thinking about that's definitely a disclosure item in your MD&A. Next thing is going to be liquidity and capital resources. What's important about this is, once again, you've got to describe the extent to which a company's liquidity has been impacted by COVID-19. So COVID-19 has impacted a lot of industries. So you could say if it's impacted revenues, either positive or negative. So if you're a software company like Zoom, it probably positively impact you because more people are using Zoom as a way to communicate. But if you're in the restaurant industry, where not as many people are able to go out and have a sit down meal, revenues may be a little bit different. And so once again, it's not just a backward looking analysis, it's also forward looking. If you think that there may be changes in your industry that are long standing, you definitely want to talk about that. Next thing is access to capital. Access to capital is really big, because early on I want to say in March and in April and May, that there were a lot of concerns about the stock market and the price that you can do deals at, and whether you would be able to do deals. So some companies were saying, hey, we don't think that the capital markets are as favorable, so they would have to think about that. But then later on in the summer, that things seemed to improve, and other companies were able to do transactions and financings. So to the extent COVID-19 is limiting or expanding your access to capital, you definitely want to look into that. And the last thing is debt covenants. Debt covenants is a really, really big item to discuss in your MD&A this year, because to the extent that you're not able to meet your debt ratios that you have to meet because of revenue, because of loss of revenue, different things like that, it's really important to analyze those debt covenants and your various convertible or non-convertible debt instruments you have to make sure that one, you're not currently running afoul to them, but two, to the extent that you think that there may be more pressure to do certain actions to make sure that you meet those covenants, you probably want to disclose those in the MD&A. So now that I've finished talking about the MD&A considerations, let's switch gears to talk about forward-looking statements and drafting tips related to that in our next slide. So what's actually, let's go to risk factor drafting tips. So risk factors are what I like to call a company's insurance policy. It's very important to make sure that your risks are not only narrowly tailored to your business, but they're actually relevant to what's going on. So what you need to do for this upcoming season is to update your risk factors to reflect risks that are no longer hypothetical. For example, you'll have certain risk factors that you say pandemics or disasters may impact our business. Well, to the extent COVID-19 it has impacted your business, the risk factor would say that COVID-19 has impacted our business and discuss how.
I think we're all hoping that they would have done that already. So, but it's always good to review.
Agreed. Kimberly is absolutely right about that. Second thing is update to reflect updated expectations. So where we were in March and April is with respect to the pandemic is a lot different than where we are now. So it's a consistent updating and evaluating the circumstances and evaluating where we are and update your risk factors accordingly, because what we know more now in December of this year than we knew back in February and March this year. And then lastly, you want to evaluate your previously disclosed COVID-19 specific risk factors. I know earlier in the year when we were in March and April, a lot of companies and a lot of industries were still trying to figure out, one, how long the pandemic would be, two, if it was just going to be a month and then we'd be back to business as usual. And so the risk factors may not have been what they are now. So to the extent that situations have changed with related to the COVID specific risk, maybe you're able to narrowly tailor the risks down to a couple things, then definitely do that. So now that we've talked about the risk factor drafting tips, now we'll go to the forward-looking statement to drafting tips. So once again, in a COVID environment, you need to use language that's more forward-looking than historical. To definitely detail how a company's COVID-19 response includes its efforts to protect the health and well-being of its workforce and its customers, and it is progressing. And then just discuss how operations and financial conditions may change efforts to fight COVID-19, and then the progress of that. So that's what we're seeing on the COVID-19 front. Now I'm going to kick it back over to Kimberly to talk about the modernization amendments and different items like that.
So, we gave Anthony kind of the interesting stuff to talk to. So now I'm going to have to take you through a bit of a slog over some of the changes to Regulation SK. So, but that's okay. We like Anthony, so we were delighted to let him kick things off. So let's talk about this. So the SEC recently revised portions of Regulation SK. They also revised MD&A. Cam's going to be talking to you about that in a few minutes. But first, let's talk about what the changes were right now for particularly description of business, legal proceedings, and risk factors. So these are now currently in effect. They went into effect on November 9th. For many people, there wasn't much of an impact to the Form 10Q. But nonetheless, as we go into the 10K, these will become much more relevant as we will discuss as we go through. So one of the things that they did is they cut back on some of the line item disclosure requirements. We've really gone to more of sort of a holistic principles-based disclosure. And the thought is that companies will tailor their own disclosure to their own circumstances. It's sort of a holistic approach to disclosure. You have to decide what you believe would be material to your investors. Next slide, please. So let's go through one of sort of the big changes is that, under the prior rules, you had to discuss the general description of the business over the past 5 years. Mergers, bankruptcies, various things like that. So some significant changes with business. It was always there. It was always required. You had to go back 5 years. whether or not anything really happened in the last 5 years. Or if there was a large change, 2 years ago, you still had to go back 5 years. So this has now been changed. So they've taken out that 5-year time frame with a materiality framework. Again, a lot of these changes are going straight to that, that principles-based disclosure. It requires, information material to the understanding of the general development of the business. Some issuers will welcome this change because when they look at their disclosure, the sort of the 5-year rule didn't make much sense for them. Others are like, well, how do I really know what's material? And this can go into a principles-based disclosure, can lead to some anxiety because you don't have some specified disclosure that you can kind of like walk through and tick the boxes. So, but one thing this does do is that they have now indicated, the SEC has indicated that, well, once you do sort of that one, once you've got that full disclosure, that covers sort of the general description of the business, you're allowed in your next 10K to simply do an update. So let's say you have very fulsome disclosure and it's relatively lengthy. There's things that happened, a few years ago or a couple of years ago. And so that was already there. And since that time, you'd really rather just talk to your investors about really what's happened during that last year. You can do that. So what you can do is once you have provided, that fulsome disclosure of the development of the business, what you can do in the next year is simply provide an update since that time. It has to be at least a year long. So you can't just cover, it's like, well, it's only been 9 months since we filed our last one or so. No, it has to cover the full fiscal year. And then you have to put a link back to that prior filing. Now, keep in mind, you can only put in one link. So you can't just do sort of like one big filing and then in 2021 cover a year and then 2022 cover a year and then put, and just include all the links. You're only allowed to do one link. So if you want to have the full disclosure, as that was filed in like spring of 2020, by the time you get to your 10K of 2022, if you're just looking to do updates, you're going to have to update back to that spring of 2020. So you'll end up having, a couple of years because you have to provide the updates since the time of that last full disclosure. And things like, one of the things that we will note that they've now specifically called out is that if you have previously disclosed a business strategy and there are any changes to it, then you need to discuss the material changes to a previously disclosed business strategy. If you've never disclosed a business strategy, you don't need to worry about it. You don't have to disclose it now, but if you previously disclosed it and now there have been changes, you do have to update that disclosure. Next page, please. All right, so narrative description of the business. So again, you're going to get tired of the phrase principles-based approach, but nonetheless, we're going to be hammering on that one today. But this one goes into, there's more, they do want you to discuss the things that would be considered material and one of the non-exclusive lists of disclosure topics: revenue generating activities, product services, new or enhanced products, resources such as raw materials, seasonality, and then another one: material effects of activities subject to renegotiation by government or cancellation of contracts at the election of government. So depending on what kind of either contracts you have, or if there's particular activities where the government can either force a renegotiation or cancel some contracts, that does have to be disclosed. I expect that it's likely that if you have something like that that's very material, it already would have been disclosed, but this is something that's been sort of called out. Next slide, please. All right, so here's where we get into, I most charitably describe it as sort of a pile of mush. Because what the SEC has said is one of the things that they want to discuss is a description, this is new, a description of the registrant's human capital resources. And that includes, the number of persons employed. And then the next one is any human capital measures or objectives that the registrant focuses on in managing the business, such as, depending on the nature of the registrant's business and workforce, measures or objectives that address the development, attraction, and retention of personnel. That is the SEC's guidance. I've just read it to you. They were very clear. They did not want to specify what had to be disclosed. They again wanted to go to every company is different. What they want to know is what are your practices? This disclosure does not require that you adopt new policies. It does not require that you adopt specific practices. What it does want to do is, how do you manage your people? And the discussion topics really are up to you. It will depend on what matters. I think a number of people think very commonly diversity, retention efforts, succession planning, health and safety, workforce metrics that are used as part of compensation decisions. In other words, the different things that you consider when thinking about and managing your workforce. So that if there are, particular concerns, particularly with respect to COVID, relating to retention, and so there's certain policies that you're putting in place to make it attractive to try to keep people, because keeping your workforce is critical to you, as it is to many industries. That's something that should be discussed. So, it is, and some people will also discuss things like gender pay ratios and so on. The kinds of things that they consider to be important. Again, this is in like under MD&A, it's just like how do you manage when you're looking at the company, how do you think about your metrics? What things are you looking at to measure? It's really the same thing here. Is like, how are you thinking about your workforce, your human capital resources? What do you do to retain them? How do you manage them? What are you measuring? So like I said, this one I think is going to require sort of the most thought, because it allows you to either both talk about either what's happened with COVID, what might be happening in the future, either if it's expansion of telecommuting, et cetera, or what you're doing to retain your employees. So it really is very much up to you as to what you do. So that's why this one, because we're expecting to see a lot of new disclosure, this is maybe the one that requires the most thought. Next slide, please.
Yeah, and before we move on, Kimberly, definitely agree. I think we're going to see a wide variety of disclosure.
Yeah, I agree. Some people will be using tabular disclosures like, geographic diversity, like especially if they have, workforce across the country or across the world. Where is your workforce located? Some people may, as part of this, when they're discussing diversity or otherwise, they may decide to disclose some of their EEO1 data relating to their employees in the United States. So yeah, this one is going to be, very much open for, interpretation. All right, so let's jump ahead because we have a lot of slides to cover. And as I warned Cam, I do tend to talk on. So, all right, let's go into some other things where we'll touch on them less. So regulatory compliance disclosure, it is not just environmental laws, it is all material government regulations, impact on expenditures, earnings, competitive positions. So, again, I think most companies already view, significant government regulation as a concern. So this is just making sure that people know that it's not just environmental that we care about. Next slide. All righty. Okay, so when we're talking about legal proceedings, so one of the amendments is that you can, when you're discussing legal proceedings disclosure, if it's located in the document elsewhere, many times people will put this in the notes to their financial statements, some of the discussion. You can add a cross-reference specifically now, but if you decide to do that, discuss it first with your auditors to ensure that when you're thinking about materiality thresholds, that the materiality thresholds that you consider relevant for purposes of your legal proceedings disclosure and the stuff that you're using in your financial statements are the same. All right, so, and the other one, and this is a new one, is that increases we always had to disclose if there are environmental proceedings resulting from potential monetary sanctions, right, in which the government is, in which a government authority is a party. So that actually used to be 100,000, it's gone up to 300,000. But I will tell you, for some major companies, 300,000 will not be material. It's barely a rounding error. So registrants are allowed to select a different threshold if you think it's reasonably designed to result in material environmental proceedings. So it can't exceed the lesser of $1 million or 1% of the current assets. So the most it would ever be is $1 million. So, but for large companies, that does provide more flexibility in terms of, you know, what things hit materiality. Next slide, please. All right, risk factor disclosure. Okay, so if you have more than 15 pages of risk factors, you have to include summary risk factor disclosure of no more than 2 days. So if you have 15 pages, I'm not saying that you need to shorten it. If you decide you need 15 pages, perfectly fine. But if it goes more than 15 pages, then you do need to have that summary disclosure. And many ways, that simplest way to do that might be in your forward-looking statements, many times that you'll have sort of a bullet point list of risk factors that are just there in a very, very, very summary format as part of your forward-looking statements. That might be an excellent way to, so you're not trying to reinvent the wheel, that kind of bullet might form an excellent basis for your summary risk factor disclosure. Again, it goes to, you know, the principles-based disclosure, but it's now material risk factors as opposed to most significant. I will tell you, I've always kind of read those to be the same thing, but nonetheless, they did change that language. All right, so now you have to do, this is one thing you are going to have to do, no matter how many pages you have. You do have to organize your risk factors under relevant headings. Many people already do this. So if you already do this, you know, pat yourself, give yourself a gold star, you don't need to touch it. But if you don't, you do need to organize it under headings. It could be industry risks, financial risks, you know, either business risks, kind of anything that you believe would be, or, you know, risks relating to specific securities that you have outstanding, you know, kind of anything that you believe is an appropriate division. Now, if it is a risk factor that can apply to absolutely any company, then you have to drop those at the end and they have to go under the heading called general risk factors. The SEC is not wild about the concept of general risk factors, but nonetheless, they do acknowledge that, you know, they do exist. All right, let's keep going. Next page. And I'm going to turn it over to Cam to discuss MD&A with you.
Yeah, thanks, Kimberly. So very recently, the SEC adopted these modernizing amendments for the MD&A and certain financial disclosure. I have to say they've been very busy up till this year end in anticipation of the change of the administration. So compliance likely will be mandatory for 10-Ks filed in 2022 for calendar year-end companies, but filers do have the option of complying anytime after the effective date, which hasn't been published yet, as long as they provide disclosure responsive to an amended item in its entirety. We have provided a summary and citations to the amended rules for your future reference in these slides. But in brief, the amendments are intended to simplify and enhance the information that's presented in these sections and give issuers additional flexibility to provide only information that is material to their businesses. The requirements to provide historical financial information have definitely been slimmed down, just given, you know, inline XBRL, hyperlinking, and the other technology that makes this information more accessible now in these filings. The revamped MD&A objective emphasizes a discussion of cash flows and forward-looking information, which, you know, coincidentally is in sync with prevailing investor concerns on the COVID-19 era. Eliminated disclosures include 5 years of selected financial data, 2 years of supplementary financial information, inflation and price changes unless they're part of a known trend or uncertainty, off-balance sheet arrangements unless they are material, and so that's the caveat Anthony and Kimberly have always been talking about, its materiality, and the contractual obligations table, which has been replaced by a principles-based discussion. We have to note that there were some dissenting commissioners who stressed the usefulness to investors of the contractual obligations table, and they also noted the absence of rulemaking on ESG disclosure. Since the Biden administration has signaled that climate change will be a priority, we may be seeing further adjustments to these amendments. Next slide, please. One useful amendment that allows issuers to compare the current quarter with either the prior year period or the immediately preceding quarter, but there are a couple of catches. If sequential quarters are discussed, then the company must summarize the financial information for that immediately preceding sequential quarter. or identify the prior filings that present such information. And if there is a change in the form of presentation pursuant to this paragraph, the company has to discuss the reasons for changing the basis for the comparison and provide both comparisons in the first filing in which the change is made. So each company will really have to weigh whether the change in format is worth that additional disclosure and thought. The liquidity and capital resources section will require more detail around cash needs over short versus long-term periods and anticipated sources of funds. The SEC also added certain parallel amendments to the financial disclosure requirements that are applicable to foreign private issuers, including amendments to Forms 20F and 40F. Next slide, please. Moving on to small news, but significant news. The SEC. Yeah, right. I mean, this is like, hey, why didn't this happen before? So the SEC amended its rules to permit e-signatures on many SEC filings and for SEC administrative proceedings and service of process. And so the eligible filings are, quite broad, includes 34 Act reports, registration statements, and Section 16 reports, and they became effective immediately on publication in the Federal Register. Just, a few things to know. The term electronic signature is pretty broad, and it's consistent with the widely used definition of the term in the e-Sign Act. So what forms of e-signature would be acceptable under the new rule? The good news is that there should be quite a bit of flexibility to rely on email responses, as well as e-signatures executed through a board portal or DocuSign if they meet the requirements of Rule 302. And when we look at those requirements, really the first two provide assurance of the identity of the signatory and that they can't falsely deny having signed the document. So whatever platform is used to collect the signature should be password protected or have some other mechanism that requires the signatory to authenticate their individual identity. Note that the requirement that the signature be, quote unquote, logically associated with the signature page, but the e-signature doesn't need to appear on the document itself. So instead, it could be a reply signing off on a document that's attached to the same email. The timestamp could be tricky for signatories who are used to leaving the date blank, but I imagine from the SEC's perspective, the ease of obtaining the e-signature outweighs the inconvenience of having to collect the signature at or shortly before the filing date. And of course, before signatories can use electronic signatures, they have to manually sign a consent, agreeing that the e-signature will constitute the legal equivalent of a manual signature. And then you have to retain the consent for at least 7 years after the date of the most recent electronically signed report. But you can retain it either in paper or electronic form. And we've actually provided a sample copy of an e-signature attestation in the supplemental materials that we hope will be useful to you. Next slide, please. Now we're going to move on to critical audit matters. Anthony?
Fantastic. Thank you, Cam. We're going to keep this particular section short. We talked about this last year. The biggest thing is to understand what a critical audit matter is, or a CAM. Basically, those are any matters arising from the audit, the financial statements communicated or required to be communicated to the audit committee that relate to the accounts or disclosures that are material for to the financial statements that involve especially challenging, subjective, or complex auditor judgment. So this has already been in effect for large accelerated filers for fiscal years ending on or after June 30, 2019. The reason we brought it back to this year's presentation is that it goes into effect for everyone for fiscal years ending on or after December 15, 2020. So just something to be aware of. The PCAOB expects that most audits to which the CAM requirements apply, that they'll find at least one CAM. And the most important thing from this is that management should consider whether the existence of a CAM should result in additional disclosure in areas in your 10K, such as your MD&A. So we'll go on to the next slide. We're just going to briefly touch on auditor independence. So the SEC adopted amendments to the auditor independence rules. These amendments were basically designed to sync up with what the PCAOB already has. So the only really noteworthy thing about the changes is that they amended the definitions of affiliate of the audit client to basically be a dual materiality threshold. What that means is, under the final amendments, if either the entity under audit or the sister entity is not material to the controlling entity, then the sister entity will not be deemed an affiliate of the audit client. So that's something that's important. But we moved through the auditor independence, and now we'll kick it over to Kimberly to talk about mining disclosures.
Oh, one thing I do want to talk briefly about, you don't need to change the slides, about the auditor independence and critical accounting and critical audit matters, is that this is an area where, the audit committee really needs to think about things, particularly if there will be any CAMs that they may want to do. Sometimes they'll do sort of dry runs with their auditors to understand, like, if there's going to be disclosure, what it would look like, because, these things sort of add more time and complexity. And the audit committee will, of course, want to make sure that, they are aware of the, and are discussing with their auditor the new independence requirements, because of course, you can, you do still have to have an independent auditor. Okay.
Okay, I think now we're going to go on to the accelerated filer definition. So next slide, please. Yeah, so in March, the SEC narrowed the accelerated filer and large accelerated filer definitions, just with the stated goal of reducing filing burdens for certain smaller issuers. And so going forward, smaller reporting companies with annual revenues of less than 100 million in the most recent fiscal year are excluded from the accelerated filer definitions. And most notably, what this means is that they're exempt from providing an annual auditor attestation of management's assessment of internal controls over financial reporting. For all filers, don't forget to add a new checkbox to the annual filings on 10K, 20F, and 40F to indicate whether or not an auditor attestation over internal controls is included in the filing. And so there, we're going to move on, I think. Next slide.
So the next slide's mine, and I promised Cam that I would do this in less than a minute. One point I will want to know that I was a little unhappy with the prior rule and the amendment for accelerated filer, because part of it ties to the smaller reporting company definition. If you file in IFRS, you cannot be a smaller reporting company. So no matter, even if you think your revenue numbers and everything else works, if you're relying on the revenue numbers, you cannot rely on that revenue test to essentially be a smaller reporting company. All right, so mining disclosure, we are going to spend about 30 seconds on the next two slides. Mining disclosure, yes, it does go into effect on January 1, 2021. So in about 2 weeks. For most companies, it will impact their 10K filed next year. So in other words, it'll be in effect next year, which means it'll impact your K filed in 2022. Early compliance is permitted. If you're a new registrant or filing a long form registration statement, you will have to start complying after January 1, 2021. If you don't know what this is, and you have reserves and resources and you're about to file a report, please give me a call, and then we can start to panic quickly. Next slide. All right, so this is brand new. It's not brand new. This has happened before. These rules were originally adopted, disclosure payments by resource extraction issuers, originally adopted in 2016, later disapproved by Congress under the Congressional Review Act, though they were required under Section 13Q. So the SEC has to adopt these. They are mandated to adopt these rules, but they can't make them exactly like the last ones that went in 2016, because under the Congressional Review Act, once they were disapproved by Congress, they actually do have to change. These are much less onerous. The disclosure will be easier. Information is furnished, not filed with the SEC. So it's going to limit liability. And let's be clear, we have a very long transition time in front of us. So you do not need to lose sleep about this at all. So Even after these are effective, which will be 60 days after publication, there's a 2-year transition period. So assuming you're a calendar year end company, it is not likely that probably most likely that you'll be filing a Form SD by September 30th, 2024. Yes, you heard me right, 2024. Essentially 3.5 years from now. So like I said, this is not something to lose sleep over. You can lose sleep over it later. Let's move on.
Okay, thanks, Kimberly. I think now we're on to the proxy statement disclosure issues, and we'll start with COVID-19 disclosure trends so we can advance to the next slide. You know, the pandemic has really resulted in a reboot and expanded disclosure on a number of sections of the 2021 proxy statement. Cover letters provide the chair or the CEO with an opportunity to present a big picture of 2020 for the business and how governance and compensation practices helped address challenges and opportunities presented by the pandemic. Beyond the cover letter, we are seeing more robust disclosure on risk management and human capital management, given the large-scale shift to work from home for some employees and the health threat to those who continue to work in hospitals, offices, stores, and factories. Companies also face risks to operations and supply chains and are addressing how they manage those risks in the governance sections of proxy statements. For those companies that provide disclosure on their social initiatives, we're seeing disclosure about programs addressing the needs of customers, community members, employees, and suppliers during the crisis. For sure, boards and management will be facing tough decisions on the return to in-person work environments, and namely whether or not to require vaccination. Considering one recent survey indicated that 50% of Americans will not take the vaccine as soon as it is available to them, there will be competing considerations of individual autonomy, the risk of side effects, and workplace safety to balance. There is a constitutional basis for requiring vaccination to attend school absent religious or medical exemptions. And there's also a public policy precedent for the federal government to compensate manufacturers and recipients for injuries associated with routinely administered childhood vaccines through the National Vaccine Injury Compensation Program. So as these discussions happen in the boardroom, we expect that they will filter into the proxy statement discussion on governance issues as well. On the compensation front, compensation programs had conflicting priorities, and they often need to be retooled to preserve cash while still retaining and motivating key employees. Semler Brocy's analysis of Russell 3000 companies that announced changes to their current and future incentive plans as a result of COVID generated these noteworthy observations. Nearly half of the companies announced temporary salary reductions. Annual incentive plan changes most commonly consisted of reduced targets or max payout opportunities, and the addition of new metrics commonly focused on liquidity or strategic measures in the context of the pandemic. While changes to long-term incentive plans were not as common as annual incentive plan changes, there were still changes to PSU metrics, typically to those more focused on operational health and more easily forecasted. And there were a significant percentage of companies that granted special awards or elected to cancel outstanding grants. So companies are dealing with performance targets and metrics that are no longer meaningful. The question is whether to keep, modify, or replace them. And what we should keep in mind is that if the modification results in incremental fair value under FASB Topic 718, the disclosure rules essentially treat the modification as the issuance of an incremental award that is reported in the compensation tables and discussed in the CD&A. And there are also potential disclosures triggered in financial statement footnotes on Form 8K and exhibits for subsequent Form 10Qs. And the uncertainty continues. In addition to past awards, companies are having to decide how to structure incentive awards, targets, and metrics for 2021. They have offered benefits to executive officers to enable them to continue their work and otherwise to make their lives easier during the pandemic. According to a recent C&DI, filers are to apply the SEC's existing two-step analysis to identify whether an item constitutes a perk or personal benefit. And so the example that the SEC provided there is that enhanced technology needed to work from home during a stay-at-home order would generally not be a perk, but health-related or personal transportation benefits would be, which kind of raises a question. So what about the COVID vaccination itself? You know, I think from our mind, if it's offered to all salaried employees on a general basis, not so much a perk. And so just taking a step back, I think this year it will be important to remain sensitive to COVID's impact on the broader employee base. Large executive bonuses and incentive payouts will receive particularly close scrutiny if there were furloughs or terminations, or if employees took pay cuts. And of course, it always makes sense to remain sensitive to investor policies. We have provided a link to ISS's FAQs on executive compensation decisions during COVID in the appendix to this presentation. Certain actions that would be considered problematic under normal circumstances might be reasonable in this context, so long as the justifications and the rationale are clearly disclosed and the resulting outcomes appear reasonable. Next slide, please. So now we're going to turn it over to Anthony to talk about some of the diversity trends that have fundamentally shaped proxy statement disclosure for this upcoming year.
Fantastic. Thank you, Cam. So what I'm going to talk about are board diversity trends, both at a state legislation level. Specifically, there's legislation and laws in California and Washington that directly relate to disclosure items related to board diversity, and then there's an upcoming NASDAQ proposal that have accepted and adopted would change how public companies who are listed on NASDAQ handle diversity and disclose diversity issues in their proxy. So if we go to the next slide, that the first thing I'd like to talk about is state law. So board diversity at the state level, specifically California. So California recently adopted Assembly Bill 979, which what it does is it requires boards of covered corporations, which we'll get into what that means in the next slide. But what it means is it's going to require boards of covered corporations to have at least one director from an unrepresented community by the end of 2021. So in order to comply with that, the first kind of issue or thing, what one person or company needs to think about is who classifies as an unrepresented community. So under the law, it says a director from an unrepresented community means an individual who self-identifies as Black, African American, Hispanic, Latino, Asian, Pacific Islander, Native American, Native Hawaiian, or Alaska Native, or who self-identifies as gay, lesbian, bisexual, or transgender. So the new bill also requires boards of covered companies with 4 or 9 directors to have at least 2 directors from an unrepresented community, but by the end of 2022, and it requires boards of covered corporations with more than 9 directors to have at least 3 directors from an unrepresented community by the end of 2022. This is pretty significant because Assembly Bill 979 is a direct follow-up of Senate Bill 826, which has been in effect in California, but for about a year now, which that one required boards of covered corporations to have at least 1 female director by the end of 2019. And then it requires boards of covered corporations with 5 directors to have at least 2 female directors by December 31, 2021. And then requires boards of covered corporations with 6 or more directors to have at least 3 female directors by December 31, 2021. One thing that's interesting about these two laws in California is that just because you meet one standard doesn't mean you meet the other. And the California legislature hasn't been very specific on whether you meet, if you can meet both criteria with the same board member, or if you need additional board members. So let's head over to the next slide. So when I talked about covered corporations or subject corporations in California, it must meet each of these 3 elements. So it must be a corporation. So LLCs and different types of structures are exempt. It has to have its outstanding shares listed on a major U.S. stock exchange. So NASDAQ, NYSE, that's how that is. And its principal executive office is located in California, and that's going to be according to the company's 10K. So the reason this is so important is this covers California companies that are Delaware incorporated or incorporated in other jurisdictions, if they have California as their principal office location on their 10K, they're subject to it. And so there's various monetary fines for not complying with the law. So you got a $100,000 fine for failure to timely file your different filings in California to report. And then there's a $100,000 fine for companies who don't meet the requirement, and then $300,000 for successive violations. So let's head over to the next slide. So we're going to talk about the Women on Corporate Boards Act in Washington that goes into effect this year, and Washington took a different approach than California, where this particular law only applies to corporations incorporated in Washington. So it's not just you have a presence in Washington, you have to be incorporated in Washington. And it requires boards to either have a gender diverse board or provide shareholders a board diversity discussion. So this board diversity discussion would be included in your proxy. Washington took a comply or disclose approach, meaning either you have a gender diverse board or you don't. And if you don't, you have to add Y in your proxy. But as I said, it applies to public companies incorporated in Washington, but smaller reporting companies are exempt, emerging growth companies are exempt, and controlled companies are exempt. So we can head over to the next slide. So NASDAQ's new diversity proposal would require companies listed on NASDAQ to have at least 2 board members who are diverse. So at least 1 director who identifies as female, and at least 1 director who identifies as an unrepresented minority. Similar to the Washington law, that NASDAQ's proposal would require a public disclosure in the proxy to the extent that you don't have a diverse board. You would need to disclose it in the proxy. And of course, like anything, that there's a phase-in period. So assuming that the SEC approves the new listing rule, if your company is listed on the global select or global market tiers, you would have 2 years to appoint at least 1 director and 4 years to appoint 2 directors. And then if you're listed on the NASDAQ capital market, you would have 5 years to meet the requirement. So we can head over to the next slide. Now I'm turning it over to discuss about sustainability disclosure trend.
So we're really just going to discuss this briefly. As you're aware, many large institutional investors, including the Council of Institutional Investors, are urging companies to report on their sustainability performance. So ESG is becoming more visible. As Cam noted, with the Biden administration coming in, we may see proposals and eventual rulemaking mandating specified ESG discussions. So there would be then standardized disclosure. Before that, however, people still want the disclosure. And right now it's a bit of a hodgepodge. Many people who report will report under the sustainability accounting standards. And so, but there's now been, because it is such a hodgepodge, there are 2 major initiatives that came out in September. We've noted them both here. The first one is there's essentially, 5 major standard setters. They came together and they're going to be, their goal is to provide guidance about how to use their existing frameworks, as I describe it, in a complementary and additive way. In other words, they're not coming up with a new proposal. They're just going to try to tell you how to use all of their frameworks together. The World Economic Forum's International Business Council, along with the Big Four, they've recently published a white paper. Essentially, what they are putting together and trying to put together is broader and more substantive common standards, because I think that's been very frustrating for a number of issuers. as to, it's not clear as to, what standard you should follow, what are people really looking for other than just more. And some it's a question of where you put it. Many companies are not putting it into their filed documents, but rather putting it into separate sustainability reports that they publish for matter of liability or other purposes. So we'll see what ends up happening here, but we expect the trend, as we've noted, just diversity disclosure is going to be expanding dramatically, and we're expecting the rest of that to expand. But why don't we move on?
Thanks, Kimberly. So there's no doubt that the virtual format generally led to shorter meetings and shorter Q&A periods. In 2020, Broadridge reported that meetings averaged 18 to 34 minutes. And in particular, the time spent on answering questions decreased to from 12 to 10 minutes. But given the ongoing COVID restrictions, virtual meetings continue to be the prevailing format for over 90% of early filers in the 2021 proxy season, according to an informal Broadridge survey. Having said that, it's important for all of us to continue to be sensitive to investor policies on virtual meeting disclosure. Glass Lewis has fairly robust requirements there, and also investor support for hybrid and in-person meetings, which could influence the later 2021 proxy season and then future proxy seasons. Next slide, please. Companies choose to hold virtual meetings should continue to consider applicable SEC guidance, as well as restrictions under state corporate law and their governance documents. And it'll also be important just to pay some attention to the virtual meeting format and to address any glitches from last year. And so some glitches that have been discussed by CII and investors and have been in the press include a delayed mailing of proxy materials, which some say potentially impacted retail voting by 3 to 5% in 2020. So companies should consider mailing further in advance if that was an issue. There were also difficulties accessing meetings, particularly where a custodian bank does not use the virtual meeting platform control numbers. And so pieces of advice there, provide guest access so at least shareholders can attend, but then they can't vote at the meeting, which isn't ideal, but at least they can listen in. Another glitch, late pre-registration instructions. So consider eliminating pre-registration altogether, since shareholders already need control numbers to access the meeting. There's also been quite a bit of debate on the lack of transparency around Q&A and whether all questions are being addressed, which is all the more important to distribute rules of conduct prior to the meeting and that are clear on which questions will be omitted. I know last year, quite a few companies just posted the rules of conduct on the meeting site itself, but consider doing it, posting it beforehand as well. There was an inability of beneficial holders to ask questions at some meetings because they didn't hold legal proxies. So that's something else to reconsider, is whether a company would require that legal proxy in order for someone to ask a question. If there are shareholder proponents, they should be given the opportunity to present their proposal on a live basis. Okay, so whether that means providing a separate line, having management read the proposal, or alternatively give them the option to pre-record their presentation. Those are some of the ways that we can keep shareholder proponents happy and engaged in the process. And finally, something else to consider, the lack of availability of management or directors to answer questions. So can there be a separate line that's set up so that they are available just in case something comes up? Next slide, please. And
okay,
so,
great, great. So we're at the CEO pay ratio in year 4. The only real consideration is that this is a every 3-year analysis. So year 4 is the year that you need to find and make sure that you're not using the same person, because that person may not be the proper person for the analysis. So for this, it's year 4. So you're going to have to redo the analysis and identify a new meeting employee. So we can head over to the next slide.
Okay, thanks, Anthony. I just want to note we are at the top of the hour. We are going to stay on for a few more minutes and cover a few additional topics on proxy advisory reform and ISS and Glass Lewis voting policies, but thank you for your time if you need to drop off now.
All right, we're only going to touch briefly on proxy advisory reform, primarily because the transition rules for proxy advisors is really going to be, these are the new calendar year, for calendar year companies, the new rules are really going to be applying in the 2022 proxy season, not this year. But essentially what it came down to is that, this is an ease up from the proposed rules, but it does codify that proxy voting advice is a solicitation. Voting advisors typically rely on exemptions, so they don't have to for filing and information requirements, which would otherwise apply to a proxy solicitation. So essentially the purpose of these is to ensure that clients of proxy voting advice businesses have timely access to better and more transparent and accurate and complete information when they're making voting decisions. Next slide, please. So essentially, effectively what it comes down to is there's two primary purposes here. That proxy advisors are going to have to disclose material conflicts of interest, and they are not supposed to be using boilerplate disclosure. And they also have to have adopted and disclosed policies and procedures so that registrants that are subject to proxy voting advice get that advice available to them at or prior to the time the advice is given to the proxy advisor's clients. Now, unlike the proposed rules, they don't have a right to review and respond to the report before it's given out. So that was a change. And then they also have to have a policy that says the proxy voting advice business provides clients with a mechanism so they can reasonably be expected to become aware of any issuer written statements responding to the proxy voting advice. So in other words, if someone responds to an ISS report, that clients are aware that the company has done either through additional definitive materials or otherwise, they're aware that the registrant has responded, to clarify some of those. Next slide, please. All right, so what is effective now? There was some supplemental guidance to investment advisors. This is done in a Q&A format. What it really tries to come down to is to clarify under what circumstance when a proxy firm's electronic management system, pre-populates advisors' ballots with suggested voting recommendations, they should consider whether an investment advisor should consider whether its policies and procedures, address the circumstances where an issuer does file or has filed response materials. And then it also talks about disclosure obligations and client consent where investment advisors use automated services for voting. It kind of goes to, making sure that an investment advisor's clients understand how those decisions are being made. Next slide. All right, we're going to very, very briefly touch on some things again, it goes back to ESG issues. ISS and Glass Lewis both are focusing on environmental and social issues as part of board oversight. So both proxy advisory firms came out about this. Glass Lewis is very specific. They want to see clear disclosure concerning board level oversight on these issues. Who is doing it? And so the question really comes down to if that isn't clear from your current disclosure, or if the board committees, aren't entirely clear as to who does what. This may be a topic to discuss with your board or your governance committee as to where is that board level oversight so that you can provide that disclosure and to provide very clear disclosure to your investors. Next slide. Gender diversity, again, these are sort of updated for last year. Mostly we've just sort of passed transition years here. So we've gone through and given you kind of what the guidance is going to be. So just so you know that is now, that's been updated. So that is there, that is summarized. Next slide. racial and ethnic diversity. This is new, a new policy for ISS. So it will be effective for meetings in 2022. For 2021, the research reports are going to highlight boards that lack racial and or ethnic diversity. It doesn't factor into vote recommendations this year, but it is going to be highlighted in reports. It will become an issue in 2022 and can impact the chair of the nominating committee if there are no apparent racial, ethnically or racially diverse members. Next slide. So why don't we keep going? This just kind of goes through the rationale. I think there's nothing about this that's really a surprise. Glass Lewis, same thing for reports for S&P 500 companies. They're going to be including an assessment, and it's going to be talking about the current percentage of racial and ethnic diversity, and whether in the company's policies, et cetera. And then the review is going to be informing an assessment of the company's overall governance. Next slide. Poison pills. This is if you're thinking about putting in a poison pill, there are some provisions that will just be deemed to be unacceptable governance, which is the dead hand and slow hand pill provisions, which are described here. So if you want to put in a pill and you want those provisions in it, you may want to think again. Next slide. Keep going. Term limits. Generally speaking, neither ISS or Glass Lewis is wild about the idea of specified tenure and term limits. What they would really prefer is that the board have a very robust process for actually determining board refreshment issues. So the discussion of their positions on term limits, age limits, et cetera, are outlined in the next few slides. So in other words, ISS and Glass Lewis have always preferred a scalpel as opposed to a sledgehammer approach on these. But nonetheless, the modified provisions are contained. Next slide. We can keep going. And one more. Again, advance notice provisions. These have been modified actually a little bit more in the company's favor. They still only want a 30-day window, but they've now changed it to they've now changed the window out from to 120 days. So it's now known as the 120-day window. So that makes it a little easier for companies to have an advance notice deadline that gives them the time to actually respond. Next slide.
Thanks, Kimberly. So we are headed towards the end of our presentation here. Thank you for everyone who stuck around. In the next few slides, just some shareholder proposal trends from the 2020 season, and also a summary of shareholder proposal reform that has updated the eligibility criteria as well as the resubmission thresholds for shareholder proposals. And these amendments won't be effective until annual or special meetings held on or after January 1st of 2022. There's also some grandfathering of ownership requirements. So we'll leave these here for your consideration if it becomes an issue. And obviously you can always talk to us. But I think the fact that we've gone over is a testament to how much has transpired over this past year and the significance of the developments are going to be impacting this reporting season. So I really just want to thank my colleagues, Kimberly and Anthony, for leading us through some of these significant changes. There's going to be a lot of developments to discuss, both in the 10K and the proxy. So please do reach out to us if you have any questions. And we're wishing you and all of your families a safe and happy holidays. And I hope that we'll be meeting under better circumstances for everyone next year. Take care.